There's a little piece of plastic in your wallet that can either quietly build your wealth or silently drain it for decades. And the difference between those two outcomes comes down to a handful of secrets the banks work very hard to keep you from fully understanding. Because here's the uncomfortable truth. The credit card industry earns billions every year, not from responsible customers but from confused ones. In a recent year, Americans were charged a record of over $160 billion in credit card interest alone and paid tens of billions more in penalty fees. That money comes from ordinary people making a few predictable mistakes on purpose-designed products. Today, I'll reveal 13 credit card secrets the banks pray you never learn, and exactly how to flip each one to your advantage. Stay with me, because the secret at number 4 quietly damages your credit score even when you pay perfectly on time, and number 1 turns you into the one type of customer the banks genuinely can't stand. Here's the one idea behind all 13. A credit card can be a powerful tool that pays you, or a trap that bleeds you, and the card company profits most when you're in the trap. Almost every secret here is a way to make sure you stay the customer who profits, not the one who pays. Let's start with the most famous trap of all. Number 13. The minimum payment trap. Every statement shows a small, comforting number, the minimum payment. It feels manageable, responsible even, to pay it. That little number is one of the most expensive traps in personal finance. Here's the math they don't emphasize. The minimum payment is often just 1 to 3% of your balance, and most of it goes straight to interest, not to reducing what you actually owe. Pay only the minimum on a $5,000 balance at a typical interest rate, and it can take over 2 decades to clear, while you pay thousands of dollars more in interest than you originally borrowed. The minimum wasn't designed to help you, it was designed to keep you paying interest for as long as humanly possible. So never treat the minimum payment as your target, treat it as a warning. Always aim to pay your full statement balance, and if you can't, pay as far above the minimum as you possibly can. Even a little extra each month can save you years of payments and thousands in interest. And that trap is part of a bigger pattern with a name. Number 12. The persistent debt treadmill. There's a term financial watchdogs use for the trap we just described: persistent debt. It's defined as a situation where, over the course of a year, at least half of everything you pay goes toward interest and fees, rather than paying down what you owe. Here's why it's so insidious. On this treadmill, you can be paying every month, on time, feeling responsible, and yet barely moving forward, because half your money is just feeding the interest machine. And the share of people caught in this exact trap has been climbing, more than 1 in 8 cardholders by recent measures. They're working hard, paying faithfully, and going almost nowhere, which for the card company is the perfect outcome. So check your own statements. How much of your payment is actually reducing your balance versus vanishing into interest? If most of it is interest, you're on the treadmill, and the fix is to attack the balance aggressively, pay far more than the minimum, or move the debt somewhere cheaper until you're paying down principal, not just feeding interest. And there's a way to make the card owe you instead. Number 11. The grace period gift. Here's a secret the banks would rather stayed quiet, because it's how savvy people use credit cards for free. Most cards have something called a grace period, and used correctly, it lets you borrow the bank's money at zero cost. Here's how it works. If you pay your entire statement balance in full by the due date, every single billing cycle, you typically pay no interest at all on your purchases. None. You've essentially borrowed the bank's money for weeks, made your purchases, earned any rewards, and paid nothing for the privilege. The catch, and the reason they don't advertise it, is that this gift vanishes the moment you carry a balance. Once you don't pay in full, interest often kicks in, and the free ride is over. So protect your grace period like treasure. Pay your statement balance in full, every month, without fail. Do that, and your credit card becomes a tool that works for you. Convenience, security, rewards, all at no interest cost. And the flip side is a trap disguised as a gift. Number 10. The deferred interest bomb. You've seen the tempting offers, especially on furniture, electronics, or big purchases. 0% interest, no payments for 12 months. It sounds like free financing. Hidden inside some of these deals is a ticking bomb. Here's the trap. Many of these promotions aren't truly interest-free, they're deferred interest. That means interest is quietly accumulating in the background the entire time. If you pay the balance off completely before the deadline, you owe nothing extra. But if you're even a little short when that deadline hits, you can be charged all the interest, retroactively, Back to the original purchase date. One missed deadline turns a 0% deal into a large, sudden interest bill. So if you use a 0% offer, read the fine print carefully to learn whether it's true zero interest or deferred interest. Then set a firm plan to pay it off completely well before the deadline, with reminders. Used correctly, these deals can genuinely save you money, but only if you beat the clock. And missing a deadline can trigger something even worse. Number 9. The penalty rate. Here's a nasty surprise many cardholders never see coming. Make one late payment, and your bank may raise your interest rate, not just on that card, but potentially on your other cards too, and at their discretion. Here's the mechanism. A single late payment can flip your account onto a much higher penalty interest rate, sometimes dramatically higher, turning an affordable balance into an expensive one overnight. And because late payments ding your creditworthiness, other lenders may quietly raise your rates as well, when you least expect it. One slip, one forgotten due date, can cascade into higher costs across your entire financial life. The banks give themselves this power in the fine print you agreed to. So guard against late payments with everything you've got. Automate at least the minimum payment on every card, set calendar reminders, and if you do slip up, call immediately and ask them to reverse the late fee and any rate hike, especially if it's your first. A quick, polite call can undo a lot of damage. And late payments feed the biggest fee machine of all. Number 8. The late fee machine. Penalty fees are a massive, deliberate revenue stream. The credit card industry collects tens of billions of dollars a year from them, and the late fee is the workhorse. A single missed payment can cost you a hefty fee, sometimes exceeding $40, on top of any interest and rate hikes. Here's what makes it so profitable. Late fees cost the bank almost nothing to charge. They're triggered automatically the moment a payment is a day late. And they prey on ordinary human forgetfulness, a due date that slipped your mind, a payment that didn't clear in time. Multiply one small fee across millions of customers who occasionally forget, and it becomes billions in nearly effortless profit. The system is built to catch you on your worst, busiest days. So take the fee machine out of the equation entirely. Set up automatic payments for at least the minimum on every card, so a forgotten date can never cost you. And again, if a fee does slip through, call and ask for it to be waived. Banks will often reverse a rare late fee for a good customer who simply asks. And one type of transaction is a trap from the very first second. Number 7. The cash advance trap. Your credit card offers a tempting feature. You can withdraw cash with it, at an ATM, or with those convenience checks they mail you. It feels like quick, easy money in a pinch. It's one of the most expensive things you can do with a card. Here's why it's so costly. A cash advance usually comes with an immediate fee, and worse, there's typically no grace period. Interest starts accruing from the very moment you take the cash, often at an even higher rate than normal purchases. There's no free window, no time to pay it back interest-free. What feels like tapping into available credit is really taking out a high-cost loan that starts charging you instantly. The banks make it easy, precisely because it's so profitable for them. So avoid cash advances, except in a true emergency, and even then, pay them back as fast as possible. Those convenience checks they send, they usually carry the same expensive terms. Treat them with suspicion, not as free money. Now let's talk about the shiny perks that lure you in. Number 6. The rewards illusion. Points, miles, cashback. The rewards are dazzling, and they're a big reason people choose and use their cards. But the banks understand something you might not. Rewards are bait, and for many people, the bait costs more than it gives. Here's the reality behind the glitter. A rewards point is often worth only about 1 cent per dollar you spend. If your card charges an annual fee, you may need to spend many thousands of dollars just to break even, and that's only if you never pay a cent of interest. Worse, the real danger is behavioral. Rewards are designed to make you spend more because every purchase feels like it's earning something. If chasing points leads you to overspend or carry a balance, the interest you pay will dwarf any rewards you earn. The bank happily gives you 2 cents in rewards to collect 20 in interest. So enjoy rewards only if you're paying in full every month and not spending more to chase them. Do the math on any annual fee against what you'll realistically earn. Rewards are a nice bonus for disciplined spenders and an expensive illusion for everyone else. And here's a hidden cost that hits even the disciplined. Number 5. The utilization secret. Here's something that surprises even careful cardholders. It's not just about paying on time, it's about how much of your available credit you're using at any moment. This is called your credit utilization, and it quietly shapes your credit score. Here's the trap I promised. You can pay your minimum perfectly, on time, every month, and still watch your credit score stay stuck or drop because you're carrying a high balance relative to your credit limit. Utilization, the percentage of your available credit you're using, is one of the biggest factors in your score. And a lower score doesn't just feel bad, it costs you real money. Higher interest rates on car loans, mortgages, even higher insurance premiums in some places. So carrying a big balance quietly taxes every other loan in your life, even if you never miss a payment. So keep your utilization low, ideally using only a small fraction of your available credit at any time. Pay down balances before the statement closes, not just before the due date, since the reported balance is what counts. Keeping utilization low is one of the simplest ways to lift your score and lower the cost of everything else you borrow. And borrowing across borders has its own hidden fee. Number 4. The foreign transaction fee. Travel abroad, or even buy something online from a foreign company, and your card may quietly tack on a foreign transaction fee, a small percentage added to every purchase made in another currency. Most people never notice it until they scan their statement later. Here's the quiet cost. It's usually a few percent per transaction, small on any single purchase, but it adds up fast across a whole trip of meals, hotels, and shopping. And it's easy to miss, because it's folded into each charge rather than listed as one obvious fee. You're effectively paying a surcharge simply for spending money in another country, a cost many travelers don't realize they're carrying until they're home. So if you travel or shop internationally, get a card that charges no foreign transaction fees. Plenty of good ones don't. It's a simple switch that can save you real money every trip. And check your card's terms before you go, so you're not surprised by a percentage skimmed off every purchase abroad. And there's one more fee that catches people off guard. Number 3. The annual fee surprise. Some of the most rewarding cards come with an annual fee, and while that can be worth it, the way the fee appears often catches people by surprise, and it's not always as fixed as it seems. Here's what trips people up. The annual fee is frequently charged on your very first statement, or quietly on the anniversary of opening the card, so it appears when you're not expecting it and can feel like a mysterious charge. Many cardholders don't factor it into whether the card is actually worth keeping. But here's the part the bank won't volunteer. Annual fees can sometimes be reduced or waived, especially if you call, mention you're considering closing the card, and ask what they can do to keep you. So know exactly when your annual fee hits, and each year, ask yourself honestly whether the card's rewards and perks truly outweigh it. If they don't, call and try to negotiate the fee down, or ask about switching to a no-fee version of the card. A 5-minute call can save you the fee, or confirm the card's still worth it. And that decision to keep or close a card is trickier than it looks, which is number 2. Number 2. Don't close your old cards. Here's a mistake that feels responsible but can quietly hurt you. You have an old credit card you barely use, so you decide to be tidy and close it. Reasonable, right? Unfortunately, closing a card can actually damage your credit score in 2 hidden ways. Here's why. First, remember credit utilization, how much of your available credit you're using. When you close a card, you erase its credit limit from your total available credit, which instantly pushes your utilization ratio higher, even though your debt hasn't changed, and a higher ratio can drop your score. Second, the length of your credit history matters, and closing an old account can shorten your average account age over time, another quiet ding, so the tidy move can leave you looking riskier to future lenders, costing you on the next loan you seek. So think twice before closing an old card, especially one with no annual fee and a long history. It's often better to keep it open, use it occasionally for a small recurring charge, and pay it off, so it quietly helps your score instead of hurting it. If a card has a fee you don't want, ask to downgrade it to a free version rather than closing it outright. Which brings us to the single most powerful secret of all. Number 1. Be the customer they hate. Here it is, the secret that ties every other one together. The credit card industry has a name, whispered internally, for the customers who cost them money instead of making them money. They're sometimes called deadbeats, and it's the single best thing you can be. Because the deadbeat is the customer who beats the banks at their own game. Here's who that is. The deadbeat pays their statement balance in full every single month, so they never pay a cent of interest. They never carry a balance, never trigger the minimum payment trap, never pay a late fee because everything's automated. They keep their utilization low, protecting their credit score. And they use the card purely as a tool, collecting rewards, fraud protection, and convenience, while paying the bank essentially nothing. The industry makes its billions from interest and fees, and the deadbeat quietly opts out of all of it, enjoying the benefits and dodging the costs. So make that